ACC 415. Financial Accounting. Study Session 1. Nature and Scope of International Accounting. Introduction. This study session introduces the students to the course, International Accounting. It encompasses issues such as the nature and scope of international accounting, the definition of international accounting, how the environment affects accounting, and the relationship between globalization and international accounting. Subheading. Meaning of international accounting. Users of financial statements require accounting information to make informed judgments and decisions. Accounting has remained the language of business by serving as the vehicle that facilitates business transactions and a means by which accounting information is disseminated to the users of financial statements. Hence, for it to be useful, it must have been prepared in line with laid down rules and regulations guiding the preparation of financial statements. Accounting and its environment. Accounting practices are a function of the environment in which businesses operate. The environment has over time helped to shape the rules, regulations, guidelines, and standards that help in the preparation and presentation of financial statements. As nations differ in the cultures, norms, and beliefs, so also have there been differences in the accounting practices and pattern of accounting development in these countries. Hence, the different rules, guidelines, and standards guide the preparation of financial statements in these countries. Globalization in financial services. In recent decades, there has been an astonishing disappearance of geographical barriers. Companies are becoming increasingly multinationals, and also the product markets. Even financial markets have not escaped the trend. As a result, companies can raise funds anywhere, sell to markets anywhere and base their operations anywhere. Against the background of the internationalization of capital markets, nations and companies have realized the need to transcend boundaries so as to benefit from this revolution, and there is the need for financial reports to mirror these changes through a common measurement and disclosure requirement. In conclusion, accounting is the language of business and it's affected by the environment and the culture of the country in which it operates. With the internationalization of capital markets, businesses have transcended across borders, hence necessitating accounting to go international. Summary of Study Session 1. In this study session, please note the following. 1. The nature and scope of international accounting. This was discussed under 4 subunits such as nature and scope of international accounting, the meaning of international accounting, accounting, and its environment, and globalization in financial services. 2. International accounting was addressed from 3 levels and also introduced as the accounting practices of companies in response to their own international business activities. Accounting was seen to have been affected by the environment in which it operates and that the globalization of international markets has necessitated for businesses to be done across borders. Study Session 2. Factors Shaping Accounting Development. Introduction. This study session introduces you to the factors that have shaped international accounting development over time. We would look at factors such as the relationship between business and providers of capital, culture, political and economic ties with other countries, levels of inflation, legal systems, size and complexity of business, and level of education amongst others. Relation between business and providers of capital. In every business venture, a major source of concern is the source of capital to run the activities of the business venture. In some instances, the providers of capital could be family members, banks, government, and shareholders. Each provider of capital requires accounting information to know how the business is doing. In countries where providers of capital are dominated by families, banks, or the state, there will be less pressure for public accountability and information disclosure. Banks and the state will often be represented on the board of directors and will therefore be able to obtain information necessary for decision-making from inside the company. As companies become more dependent on financing from the general populace through the public offering of shares of stock, the demand for more information made available outside the company becomes greater. It simply is not practicable for the company to allow the hundreds, thousands, or hundreds of thousands of shareholders access to internal accounting records. Culture. Culture is defined as collective mental programming that distinguishes the members of one group from the other groups. It is also defined as a set, which includes knowledge, belief, art, morals, law, custom, and any other capabilities acquired by people as members of society. Political and economic ties with other countries. Political and economic ties with other countries are a very important factor that has shaped accounting development as accounting ideas and technologies are transferred through conquest, commerce, and similar forces. The impact of this factor is also evident through history, with invading countries imposing their political, as well as their accounting system on the countries they have conquered and colonized. It is also a fact that many countries, upon gaining independence, have continued to use the same political and accounting system even though it no longer suits their current needs and economic situation, whereas others have opted for a different political and accounting system. There has also been the trend of countries adopting the accounting regimes of other countries voluntarily and involuntarily. This could be as a result of geographical proximity, close economic ties, and listing on the stock exchanges of other countries. Levels of inflation. The level of inflation, which is also known as the price level changes according to Okoye, is a major factor that has caused diversities in the practice and reporting of accounting on the international scene, because it affects the asset valuation method and because, in conditions of high inflation, it is essential to have an accounting system suited to inflationary conditions. This method, however, cannot be fully applied in countries such as Bolivia or Mexico, which have had or do have a high rate of inflation. Instead, these countries use different models that seek to reduce the impact of inflation on financial reporting to obtain relevant information. Countries experiencing chronic high rates of inflation found it necessary to adopt accounting rules that required the inflation adjustment of historical cost amounts. This was especially true in Latin America, which as a region has had more inflation than any other part of the world. Legal systems. The type of legal system is often argued to influence a country's regulatory system for accounting. According to Choi and Meek, the legal system determines how individuals and institutions interact. The Western world has two basic orientations: code or civil law and common or case law. Common law began in England and is primarily found in the English-speaking countries of the world. Common law countries rely on a limited amount of statute law, which is then interpreted by the courts. Code law countries tend to have relatively more statutes or codified laws governing a wider range of human activity. Size and complexity of the business. It is highly likely that the level of economic development a country has achieved will affect the number and size of business enterprises operating in that country. As this means that large business enterprises prevail in more developed countries, and small enterprises, in developing countries, the accounting system of developed countries with complex forms of business enterprises will differ from the accounting system of developing countries. Accordingly, accounting and financial reporting will be more complex and demanding than in less developed and developing countries, whose economies are characterized by many smaller business enterprises with less complex operations and, in turn, with simpler accounting coverage and monitoring, as well as financial reporting. In other words, different accounting systems are generated. Summary of Study Session 2. In this study session, please note the following. 1. The factors shaping accounting development. 2. The relation between business and providers of capital, which shows that the information needs of providers of capital differ, a culture which was defined as collective mental programming that distinguishes the members of one group from the other groups. Political and economic ties between countries, which shows that by countries having close ties with other countries through proximity, listing on their stock exchange, and colonial ties have influenced accounting development. Study Session 3. Diversity in Accounting Practices. Introduction. In the previous study session, we discussed issues relating to the factors shaping accounting development. It is pertinent to know that the accounting environment is diverse and hence no two countries or environments practice the same type of accounting. Accounting clusters. The variables shaping accounting development overlap to a great extent, and since accounting is affected by its environment, it's only expected that counties with similar business environments will have similar accounting systems. According to Gurnan and Meek, nations can be grouped or clustered according to accounting similarities, as no two countries have identical financial accounting practices. Each country is a unique mixture of environmental variables that together have influenced the pattern of accounting development in that country. Continental model. Countries in this accounting cluster include most of continental Europe and Japan. Businesses here have very close ties to their banks, which supply most capital needs. Financial accounting is legalistic in its orientation, and practices tend to be highly conservative. Accounting is not primarily oriented toward the decision-making needs of the capital providers. South American model. The third model includes most countries in South America, with the exception of Brazil, which speaks Portuguese. These nations share a common language, Spanish. They also share a common heritage. What distinguishes the South American model from the British American and continental models is the persistent use of accounting adjustments for inflation. These countries have a great deal of experience coping with inflation, and their accounting reflects this. Causes of differences. 1. Goodwill. 2. Income smoothing. 3. Recognition of inflation and other price level changes. Consequences of worldwide accounting diversity. 1. Corporate management. 2. Investors. 3. Stock markets and regulators. 4. Accounting professionals and standard setters. Summary of Study Session 3. In this study session, please note the following. 1. Accounting clusters, which is a result of similarities in accounting systems around the world, although no accounting system is entirely the same. 2. Differences that exist as a result of accounting diversities. 3. The opinions of various stakeholders of accounting information by looking at the consequences of worldwide accounting diversity. Study Session 4. Introduction to International Accounting Harmonization. Introduction. We have looked at the factors that shaped accounting development and the diversity of accounting information. We saw that these factors have significantly affected accounting development, thus leading to diversity in accounting information worldwide. Now, you will be introduced to the harmonization of international accounting. Definition of accounting harmonization. Emmanuel and Malgui used international accounting harmonization to mean the narrowing of differences in the disclosure and measurement standards used by companies all over the world in the preparation of their financial reports. Reasons for accounting harmonization. According to Gautier, Underdown, and Morris, the need for the imposition of standards arose because of the lack of uniformity existing as to the manner in which periodic income was measured and the financial position of the enterprise represented. Also, Porwall noted that in view of the globalization of the economy and internationalization of firms, the adoption of uniform standards has become an imperative necessity. Comparison between financial statements of enterprises of different countries or within a country or industry can be better made if the accounting standards are uniformly applied in all the countries. Benefits of accounting harmonization. 1. International financial information will be comparable, and this will remove the impediments to the flow of international investments and will place more reliability on financial statements. 2. The key benefit of one global set of accounting standards to the investor are obvious in that, among others, it would enable a more meaningful comparison of information across time periods and among companies, and it would also ensure that the nature and accounting treatment of underlying accounting transactions become apparent to the user. 3. Multinational corporations would be able to save money, cost and efforts used to prepare and consolidate financial statements if they are prepared on the same basis. 4. The task of preparing comparable internal information for the appraisal of the performance of subsidiaries in different countries, for appraisal of foreign companies for a potential takeover, and the transfer of staff from one country to another will become easier with harmonized standards. 5. It would be beneficial to those countries which do not have adequate codified standards of accounting and auditing, and to international accountancy firms, the preparation, consolidation, and auditing of these companies will be less onerous if the standards are harmonized. 6. Another group that would benefit is government. As taxes are levied on the total global income of an organization, it will be of great assistance to the national tax authorities around the world if net income was computed on similar accounting principles and practices. Barriers to accounting harmonization. 1. Users may not be conversant with the principles and rules on which it was prepared. 2. Cost of adopting and translating existing standards. 3. The size of the present differences between the accounting practices in different countries. 4. The lack of strong professional accountancy bodies in some countries. 5. The differences in political and economic systems. 6. Challenge for companies is interpreting these standards, as there are many gray areas. 7. Manifestation of national sovereignty. Summary of Study Session 4. In this study session, please note the following. 1. Accounting harmonization mean the narrowing of differences in accounting standards between countries. 2. The benefits of harmonization to include comparable financial statements, reduces diversity and standard for countries with no existing standard to follow, and 3. The barriers include the cost of translating and adopting the standards. Study Session 5. Principal factors in the harmonization of accounting practices. Introduction. In this study session, we would be looking at principal actors that were involved in calling for the harmonization of accounting standards. These factors would be classified into international ones and regional bodies. International Accounting Standards Board, IASB. International Financial Reporting Standards, known as IFRS, which is under the auspice of the International Accounting Standards Board, also known as IASB, an independent accounting standard-setting body based in London. The IASB morphed from another organization called the International Accounting Standards Committee, IASC, on April 1, 2001, that was established in 1973, and it is responsible for developing international financial reporting standards. Under the IFRS Foundation Constitution, the objectives are: 1. To develop, in the public interest, a single set of high-quality, understandable, and enforceable global accounting standards that require high-quality, transparent, and comparable information in financial statements and other financial reporting to help participants in the world's capital markets and other users make economic decisions. 2. To promote the use and rigorous application of those standards. 3. In fulfilling the objectives stated above, to take account of, as appropriate, the special needs of small and medium-sized entities and emerging economies. 4. To bring about a convergence of national accounting standards and international accounting standards and international financial reporting standards to high-quality solutions. International Federation of Accountants. The International Federation of Accountants, known as IFAC, was founded on October 7, 1977, in Munich, Germany, at the 11th World Congress of Accountants. In pursuing these goals, IFAC has contributed to the harmonization process in many ways as: 1. Began International Forum on Accountancy Development to enhance the accounting profession in emerging countries. 2. Started the Forum of Firms to raise global standards of accounting and auditing. Federation des Experts Compatibles Europeans. They started work at the beginning of 1987, taking over from two earlier European bodies, the Groupe d'études, formed in 1966, and the Union Européenne des Experts Comptables. It is based in Brussels and is member accountancy bodies throughout Europe. Its interests include auditing, accounting, and taxation. It studies international differences and tries to contribute to their removal. United Nations, UN. The United Nations organization was founded in 1945 by 51 countries. The United Nations now has 193 members, including almost all of the countries of the world. The headquarters of the UN is in New York City, and it is a center for the resolution of global problems. In recent years, the United Nations has established a secretariat specializing in international accounting. Organization for Economic Cooperation and Development, OECD. The OECD was established in 1960 and currently has 34 of the world's developed industrialized countries as its members. According to Chairs and Randianto, the OECD was established to promote world trade and global economic growth. It's involved in international accounting, especially when it comes to the financial reporting requirements of NAS in developed countries instead of developing countries. Gujarati noted that a valuable contribution of the OECD is its surveys of accounting practices in member countries and its assessment of the diversity or conformity of such practices. International Organization of Securities Commission, IOSCO, established in 1974. The International Organization of Securities Commissions IOSCO. Today IOSCO is the leading organization for securities regulators around the world, with about 124 ordinaries, 12 associates, and 61 affiliate members from more than 100 countries, and aims among other things to: 1. Achieve improved market regulation internationally. 2. Facilitate cross-border listings. 3. Advocates for the development and adoption of a single set of high-quality accounting standards. Regional groupings. 1. European Financial Reporting Advisory Group. 2. Asian Oceanian Standard Setters Group, AOSSG. 3. Pan-African Federation of Accountants PAFA. 4. Association of Accountancy Bodies of West Africa, ABWA. Summary of Study Session 5. In this study session, please note the following. 1. The principal actors that were involved in the harmonization of accounting standards. 2. The role of International Accounting Standards Board, International Federation of Accountants, Fédération des Experts Comptables Européens, United Nations, Organization for Economic Cooperation and Development, International Organization of Securities Commission, and the European Union. We also discussed the role of some regional bodies in accounting harmonization. Study Session 6. Conceptual Issues in Multinational Corporations. Introduction. By now, you may have been familiar with the term multinational corporation. This is due to the fact that the key players in international accounting are multinational corporations, known as MNC. What is a multinational corporation? A multinational corporation is a company whose headquarters is located in one country, known as the home country, but has operations in other countries. It can also be referred to as an international corporation. Some multinational corporations are very big, with budgets that exceed some nations' gross domestic products. Multinational corporations can have a powerful influence on local economies, and even the world economy, and play an important role in international relations and globalization. Motives for direct foreign investment. 1. Growth motive. A company may have reached a plateau satisfying domestic demand, which is not growing. Therefore, proceed to look for new markets. 2. Protection in the importing countries. Foreign direct investment is one way to expand bypassing protective instruments in the importing country. 3. Market competition. The most certain method of preventing actual or potential competition is to acquire foreign businesses. 4. Cost reduction/cheap foreign labor. Labor costs tend to differ among nations. MNCs can hold down costs by locating part of all their productive facilities abroad. International perspective on consolidated financial statements. Multinational companies are involved in international operations and transactions that are dominated in a currency different from the currency of countries where such companies are headquartered. The foreign subsidiaries of multinational corporations normally keep their accounting records and prepare their financial statements in the currency of the country in which they are located. They do this because it would be difficult to transact business in any other currency different from the local currency, and impractical to record these transactions using another country's currency. Consolidated financial statements first appeared around the turn of the 20th century in the United States. This was a time of great economic expansion during which a number of corporations grew into economic giants. Holding companies became important in Great Britain and the Netherlands in the 1920s, so consolidated financial statements appeared there somewhat later than in the United States. Today, they are required in both countries. The practice moves much more slowly in the other European countries. Summary of Study Session 6. In this study session, please note the following. 1. About multinational corporations. 2. What a multinational corporation is and what the motives that drive direct foreign investment are. 3. The international perspective on consolidated financial statements. Study Session 7. International Financial Statements Analysis. Introduction. Assuming you had just been recently hired as a financial analyst for a major Nigerian multinational corporation, and you are required to carry out an analysis from a set of financial statements from a Japanese corporation, which your company intended to buy over because of its sustained growth and profitability. Financial accounting reflects the environment IT serves. The use of home country ratio analysis expectation for analyzing foreign financial statements is only effective if the foreign financial accounting system and the operating environment closely parallel that of the home country. Unfortunately, that is rarely the case. Each country's national financial accounting system evolved to serve the needs of its domestic environment and in particular, the needs of the users of accounting information in that country. A framework for financial statement analysis. This explains the framework for analyzing the financial statements, as seen in the light of the culture, accounting values, and accounting systems existing in both countries of comparison, that is, the home country and host countries. 1. Culture values. The accounting system is also influenced by culture and the values that a society shares. Knowing something about a people's values can help us understand their accounting system. Values are defined as a tendency to prefer a certain state of affairs over another. Another cultural difference between the US and Japan is how society feels about uncertainty and ambiguity. A culture that prefers less uncertainty depends on institutions to maintain conformity, and deviating from the norm of the rule is discouraged, as in Japan. Rules make people comfortable because the rule prescribes what to do in any circumstance, thus, removing the uncertainty and need for judgment. 2. Accounting values. The following accounting values are not meant to be exhaustive, but are offered as representative of values that influence the development of national accounting systems and measurement and disclosure practices. 1. Professionalism versus statutory control. 2. Uniformity versus flexibility. 3. Conservatism versus optimism. 4. Secrecy versus transparency. Summary of Study Session 7. In this study session, please note the following. 1. International Financial Statement Analysis. 2. Financial accounting. 3. And a framework for financial statement analysis. Study Session 8. Information Systems for Multinational Planning and Control. Introduction. We live in the information age. The integration of the telephone, the computer, and television is producing the information highway. Information feeds management decision-making and control. In international business operations, the information system provides the information that the multinational corporation needs to plan, control, evaluate and coordinate all of its business activities. MNC affects the information system. An MNC has various levels of managers with varying degrees of authority and responsibility. The distribution of these management levels constitutes the MNC organizational structure and determines what information each level needs to plan and control its operations. The information needs to define how the data are collected and processed within the information system. Therefore, the structure of data collecting, processing, and reporting within an information system ought to parallel and complement the organizational structure of the MNC. The classic multinational company has operated as a decentralized unit with the ability to respond to national and local differences and opportunities. Communication problems in MNCs. 1. Differences in measurement and disclosure practices. 2. Ease of communication. 3. Financial and operating information for internal reporting. 4. Goal congruence. Most major companies in the United States use the profit center, or investment center concept for domestic control systems. This approach works relatively well domestically because profit center managers make the major decisions affecting their center's performance. Good decision-making ensures good performance evaluation, and good performance evaluation ensures good decision-making. The goals are congruent because authority and responsibility are delegated to the same people. Managers are evaluated based on the performance that results from their decisions. Planning defines a company's objectives and provides a strategy to achieve them. Such plans require a management control system as well as a performance evaluation system. The management control system should complement the plan so that the goals of the international managers are congruent with the overall goals of the MNC. Summary of Study Session 8. In this study session, please note the following. 1. Information Systems for Multinational Planning and Control. 2. How MNC affects the information system and communication problems in MNCs. Study Session 9. Multinational Budgeting Systems. Introduction. The budgeting process for a multinational company is basically not different from that for domestic operations, except that it must recognize diverse environments as well as the addition of the impact of currencies. The currency factor is perhaps the most visible difference between domestic and multinational budgeting. Forecasting exchange rates. Briefly stated, the forecasting techniques follow either the traditional, fundamental approach or the more recent technical approach. 1. Fundamental approach. The fundamental approach has evolved from classical economics. In applying this technique, management, usually the treasurer, assesses certain economic and socio-political variables of a nation to predict the economy's performance and how such performance will affect the supply of, and demand for that nation's currency. 3. Technical approach. Technical analysis has developed from the study of international money market behavior, in an attempt to predict cyclical trends in the demand and supply of individual currencies. Basic approaches to capital budgeting and profit planning. When examining the methods and procedures used for capital budgeting and profit planning, we find two approaches, top-down and bottom-up. If the corporate level determines the perimeter of the capital budget, the total amount of dollars to be spent, and then apportions to division, regions, and affiliates, this constitutes a top-down approach. If, conversely, the corporate level asks the affiliates to determine their capital requirements and proposed net income and the regions and divisions merely aggregate the affiliates' proposal, we refer to this process as a bottom-up approach. Building the capital budget. 1. Objectives. Prior to the establishment of a capital budget, it is important that the company determine its long-range objectives, and prepare a strategic plan that specifies timing horizons and overall capital requirements. 2. Annual and total requirements. Frequently, a negotiating period is needed during which the corporate level negotiates with the division with the region, and, finally, the region with the affiliates what capital projects will eventually yield the desired objectives. 3. Interface between objectives and capital budget. It is desirable, but not absolutely necessary, To prepare objectives for a 3 or 5-year period in sufficient detail, that is, stating requirements for each major program or project, so that the first forward year's data can and frequently do from the capital budget for that year. 4. Determination of exchange rates. The reason for making year 1 of the objectives the capital budget for the year, is the complexity caused by the need to set the exchange rates for each country's use in the objectives and capital budgeting process. Summary of Study Session 9. In this study session, please note the following. 1. Multinational budgeting systems considering forecasting exchange rates, basic approaches to capital budgeting. 2. Profit planning. 3. Building the capital budget. Study Session 10. Performance Evaluation in Multinational Corporations. Introduction. Performance evaluation is a critical issue in international accounting. The development of a multinational corporation requires an accounting system that records and reports the results of worldwide operations. Headquarters relies on information to evaluate the performance of subsidiaries and managers from all over the world. This study session begins with a definition of performance evaluation. Performance evaluation defined. Performance evaluation is the periodic review of operations to ensure that the objectives of the enterprise are being accomplished. In other words, it is a report on the success or failure of an operation. A corporation's performance evaluation is part of its financial control system. Financial measures used by MNCs to evaluate domestic and foreign subsidiaries. MNCs use various measures to evaluate the results of their operations at home and abroad. Let us discuss some of the measures. 1. Profitability measures. 2. Sales growths and cost reduction. 3. Budgets as a success indicator. Budgeting gives local managers the opportunity to set their own performance standards. In international operations, top management is not as familiar with what the standard should be. Headquarters must rely to a greater extent on good local or regional budgets, which help facilitate the strategic planning process. Presumably, headquarters uses the budget to consider the circumstances peculiar to each subsidiary. All of this should ensure a two-way flow of communication between the subsidiary and headquarters, which in turn, will improve the overall budgeting process. Summary of Study Session 10. In this study session, please note the following. 1. Performance evaluation in multinational corporations. 2. Definition of performance evaluation. 3. Financial measures used by MNCs to evaluate domestic and foreign subsidiaries. Study Session 11. Issues to consider when developing MNC evaluation systems. Introduction. In the previous study session, we discussed performance evaluation in multinational corporations. We are taking a step further in this study session to discuss several issues that must be considered when evaluating domestic and foreign operating environments, subsidiaries, and managers. Separating managers' performance from subsidiaries' performance. Many managerial accountants advocate making a distinction between the performance of the subsidiary manager and that of the subsidiary itself. In practice, MNCs report that they do not make a distinction between the evaluation of the manager and the subsidiary. Responsibility reporting as an accounting system traces costs, revenue, assets, and liabilities to the individual manager who is responsible for them. It follows that a manager who has the ability to control the results of operation should be evaluated on the basis of the results over which she or he has control. Treating foreign subsidiaries as profit centers. Profit centers located internationally do not operate in a uniform environment. They operate in an environment with different inflation rates, and different economic, political, cultural, and technological conditions. Top management is not likely to understand all the peculiarities of each environment, therefore, it will have trouble evaluating the manager's performance. Currency choice. The accounting records and financial statements of a foreign subsidiary are generally maintained in the subsidiary's local currency. Therefore, an issue arises as to which currency should be used to evaluate the performance of the subsidiary and its manager. Two logical candidates are the subsidiary's local currency or the parent's home currency. It was recommended to use local currency information. This is because it would result in far more meaningful and valid comparisons of past, present, and future operations of a subsidiary. Using the local currency is consistent with isolating and weighing the environmental peculiarities of each operating environment. Such information relates to local conditions and avoids the distortions that result from fluctuating exchange rates. A local currency perspective also applies to evaluating the foreign manager. Manager should be evaluated as meeting primary goals in the local currency. Summary of Study Session 11. In this study session, please note the following. 1. Issues to consider when developing MNC evaluation systems. This was discussed under various subunits such as separating managers' performance from subsidiaries' performance, treating foreign subsidiaries as profit centers, and currency choice. Study Session 12. Foreign Currency Translation Introduction. Introduction. The foreign subsidiaries of multinational corporations normally keep their accounting records and prepare their financial statements in the currency of the country in which they are located. Exchange rates. The major currencies of the world are traded in many places and in many ways. An exchange rate is the price of one currency relative to another. Exchange rates change for the following reasons. 1. Trade balance of payments surpluses or deficits. When a country exports more than it imports, it is said to run a trade balance of payments surplus. Surpluses cause the nation's currency to appreciate in value. 2. Relative rates of inflation. Currencies of countries with higher rates of inflation depreciate relative to the currencies of countries with lower levels of inflation. 3. Relative interest rates. Whenever one nation has higher interest rates relative to other nations, its currency appreciates in value. 4. Political factors and government intervention. For international transactions, the currencies of countries considered politically stable tend to be favored over the currencies of unstable countries. Translation. Foreign currency translation is the process of expressing monetary amounts that are stated in terms of a foreign currency in the currency of the reporting entity by using an appropriate exchange rate. An exchange rate is a ratio between a unit of one currency and the amount of another currency, for which that unit can be exchanged at a particular time. A direct exchange quotation is one in which the exchange rate is quoted in terms of how many units of the domestic currency can be converted into one unit of foreign currency. Exchange rates are also stated in terms of converting one unit of the domestic currency into units of a foreign currency, which is called an indirect quotation. A transaction that requires payment or receipt at a foreign currency is called a foreign currency transaction. A transaction with a foreign company that is to be settled in dollars is not a foreign currency transaction to a U.S. firm because the number of dollars to be received or paid to settle the account is fixed and remains unaffected by subsequent changes in the exchange rate. Financial accounting standards establish these steps. 1. Determine the functional currency. The functional currency is defined as the currency of the primary economic environment in which the entity operates. 2. Determine whether the functional currency of the subsidiary is also its home currency. 3. If the functional currency is the home currency, the current method is used. The current method translates all assets and liabilities at the current spot rate at the date of the translation. 4. If the functional currency of the subsidiary is not its home currency, the temporal method is used. Under this method, non-monetary balance sheet accounts and related income statement accounts are remeasured using historical exchange rates. 5. Under FAS 52, the temporal method is also used when the subsidiary operates in a highly inflationary environment. Companies reporting under International Financial Reporting Standards treat this differently by remeasuring the financial statements at the current balance sheet rate in order to present current purchasing power /. Summary of Study Session 12. In this study session, please note the following. 1. Foreign currency translation. 2. Definition of the exchange rate. 3. Reasons why exchange rates change. 4. Steps taken in carrying out the translation as contained in Financial Accounting Standards 52. 5. Which exchange rate should be used to translate the financial statements of a foreign subsidiary? Study Session 13. Translation Methods MNCS. Introduction. This study session is an extension of the previous study session on foreign currency translation. Having discussed the relevant issues as contained in the previous study session, it becomes imperative here that we should step further in discussing the translation method and modified current rate method. Temporal method. A mixture of different historical exchange rates and the current exchange rate is used to translate the items on the subsidiary's balance sheet and income statement. The resulting dangling debit or credit is treated as a loss or gain on the consolidated income statement. During the years that Statement 8 was in effect, exchange rates were highly volatile, and because the translation imbalance was required to increase or decrease reported income or loss, corporations experienced more volatility in their reported earnings than management desired. Modified current rate method. Under the provisions of Statement 52, a foreign subsidiary is classified as either 1. Self-sustaining and autonomous. 2. Integral to the activities of the parent company. A self-sustaining, autonomous subsidiary is one that operates relatively independently from the parent company. Revenues and expenses respond mostly to local conditions, few of the subsidiaries' cash flows impact the parent company cash flows, and there are few intracompany transactions with the parent. The local currency is said to be its functional currency. The balance sheet for a self-sustaining subsidiary is translated at the year-end exchange rate and the income statement at the average for the year exchange rate. There is no effect on reported consolidated earnings from translating the financial statements of autonomous foreign subsidiaries. This is called modified current rate method, which preserves the balance sheet and income statement financial ratios in the US dollars as in the local currency. Summary of Study Session 13. In this study session, please note the following. 1. The translation methods are a temporal method and the modified current rate method. The temporal method was based on Statement 8, issued by the Financial Accounting Standards Board, and the modified current rate method is based on Statement 52 of FASB.